$4 billion. That's what's rotting away in boat dealer parking lots across America right now. Brunswick, MasterCraft, Malibu, Marine Products Corporation, names that built the American boating industry for decades. Today, they're on life support. 2,000 workers got termination texts last month. Dealers are begging customers to take boats at 40% off. Some are just walking away from their businesses entirely. This isn't a slowdown. This isn't a correction. This is an industry that went from record profits to complete freefall in 18 months. The companies that survived wars, recessions, and pandemics might not survive this. How did nobody see this coming? And more importantly, who's next? To understand how four giants of American boating ended up on the brink of bankruptcy, you have to understand the euphoria that came before the collapse. In 2021, something extraordinary happened to the boat industry. After years of steady but unremarkable growth, sales suddenly exploded to their highest point in 13 years. Brunswick Corporation, the titan that owns Mercury Marine and dozens of boat brands, reported a staggering 67% increase in operating earnings. Their CEO, David Folks, called it a generational transformation in recreational boating. He wasn't exaggerating. Americans were buying boats faster than companies could build them. MasterCraft, known for their high-end wake boats, had a 26-week backlog. Customers were putting down deposits on boats they'd never even seen, just a catalog photo and a promise of delivery in 8 months. One dealer in Florida remembers taking 17 orders in a single day, all from buyers who didn't even ask about the final price. The numbers were intoxicating. The average boat price jumped from $47,000 to $75,000 in just 18 months. Marine Products Corporation, the company behind Chaparral and Robalo boats, watched their stock hit $27.40, an all-time high. Malibu Boats was so confident in the future that they expanded 3 factories simultaneously, hiring hundreds of workers and signing long-term supplier contracts. Wall Street loved every minute of it. Marine stocks outperformed the S&P 500 by 40%. Analysts upgraded their ratings across the board. Brunswick felt so bulletproof that they spent over $1 billion acquiring Navico, a marine electronics company, betting that the boom would continue for years. The pandemic had created 9 million new boaters virtually overnight. Remote work meant people could live anywhere, and many chose lakes over cities. Government stimulus checks became boat down payments. Marinas that had been half empty for decades suddenly had waiting lists. It seemed like America had rediscovered its love affair with the water. Every manufacturer doubled their production targets. They hired aggressively, locked in material supplies for years ahead, and built inventory like the good times would never end. After all, interest rates were near zero. Credit was flowing freely, and customers couldn't get enough. But markets, like tides, have a way of turning when you least expect them to. The first warning signs appeared in March 2023, buried in an obscure dealer forum where a Michigan retailer posted a simple question. Anyone else seeing buyer's ghost after financing quotes? Within hours, dozens of dealers across the country confirmed they were experiencing the same thing. Customers who had been eager to buy were suddenly walking away the moment they saw their monthly payments. The Federal Reserve had raised interest rates 8 times in 12 months, pushing marine financing rates to 9.5%, the highest since 2007. That $75,000 wake boat that cost $650 a month in 2021 now cost $1,100. The math was brutal, and buyers were doing something they hadn't done in years, saying no. But the manufacturers didn't see it yet. Or perhaps they couldn't afford to see it. Brunswick's third quarter 2023 production was still running at 95% capacity. They had signed ironclad supplier contracts during the shortage years, agreements that required them to take delivery of materials whether they needed them or not. They had hired thousands of workers with promises of long-term employment. They had expanded facilities based on projections that assumed 2021 demand would continue through 2025. The inventory began piling up in ways the industry had never seen. Dealer lots that typically held 20 boats now had 50. Floor plan interest, the cost dealers pay to finance their inventory, had tripled. One dealer in Texas was paying $18,000 a month just in interest to keep boats nobody wanted to buy. Inventory turnover, the industry's key health metric, dropped from 3.2 times annually to 0.8 times. In simple terms, boats that used to sell in 4 months were now sitting for over a year. By summer 2023, cancellation rates hit 35%. Customers who had waited months for their custom boats were walking away from deposits rather than complete the purchase. MasterCraft's CEO, Fred Brightbill, held an emergency meeting with his board in August. The numbers were undeniable. Retail sales had fallen off a cliff, but the production pipeline was still flowing at full speed. The smart money started moving first. Industry insiders quietly sold their stock positions. Private equity firms began circling, sensing distress. The companies that had bet everything on endless growth were about to learn what happens when the music stops. By October 2024, the marine industry entered complete freefall. Brunswick Corporation, the industry's $8 billion titan, announced 2,400 layoffs in a single day. They shuttered 2 manufacturing facilities that had been operating since the 1960s, leaving ghost towns in their wake. The company that had seemed invincible was now sitting on $780 million in unsold inventory, bleeding cash at a rate that horrified Wall Street analysts. The stock market massacre was swift and merciless. Brunswick shares dropped 61% from their peak. Malibu boats crashed even harder, plummeting from $87 to $19 in just 14 months. Revenue at Malibu fell 47% year over year. They suspended dividend payments, a move that signaled deep distress to investors. Their CEO resigned suddenly to pursue other opportunities. Corporate speak for jumping from a sinking ship. MasterCraft's situation turned desperate. Their dealer network, once their greatest strength, shrunk by 30% as retailers simply gave up. Production was cut by 65%, but it wasn't enough. Their debt-to-equity ratio hit a dangerous 2.1, and in November, they violated their bank covenants, triggering emergency negotiations with creditors. The company that had built boats for Elvis Presley and countless celebrities was now fighting for survival. Marine Products Corporation experienced something unthinkable. Their first quarterly loss in company history. They completely idled production of Chaparral boats, their flagship brand for 50 years. The New York Stock Exchange issued a delisting warning when their stock price stayed below $1 for 30 consecutive days. The human cost was devastating. In Vonore, Tennessee, 400 workers at MasterCraft's main factory learned their fate via text message. Report to HR for exit procedures. No warning, no severance beyond state minimums. Families that had worked there for generations were out on the street. One worker, a single mother of 3, had just bought a house based on overtime promises that would never materialize. At boat auctions across the country, the carnage was visible. A 2023 MasterCraft X26 with a sticker price of $189,000 sold for $98,000. The dealer lost $41,000 on that single transaction. Multiply that across thousands of boats, and you understand why dealers were walking away from their businesses entirely, leaving keys on bank managers' desks. Industry analysts studying this collapse identify 5 factors that created the perfect storm. First, the interest rate trap. When the Federal Reserve raised rates from 3% to 8%, it didn't just make boats more expensive. It fundamentally changed who could afford them. A buyer qualified for a $100,000 boat in 2021 could only afford $55,000 by 2024. The customer base shrank by more than half almost overnight. Second, the COVID bubble burst with spectacular force. Those 9 million new boaters everyone celebrated, only 2.3 million renewed their registrations. The pandemic hadn't created new boating enthusiasts, It had simply pulled 5 years of future demand into 18 months. Once life returned to normal, people returned to their previous habits. The boats they bought in desperation for something to do during lockdown now sat unused in driveways and storage units. Third, manufacturers gambled on inventory and lost catastrophically. They built boats for 2021 demand levels using 2024 material costs. When aluminum prices rose 40% and demand fell 50%, profit margins didn't just shrink, they turned negative. Companies were literally losing money on every boat they sold, trapped between high production costs and falling market prices. Fourth, the dealer squeeze created a liquidity crisis nobody anticipated. Floor planning costs, the interest dealers pay to stock boats, increased 400%. A dealer who paid $5,000 monthly in 2021 was now paying $20,000 for the same inventory. Many couldn't afford to hold boats long enough to find buyers. They dumped inventory at any price just to stop the bleeding, creating a downward spiral that pulled the entire market lower. Fifth, and perhaps most troubling for the industry's future, was the generational shift. Millennials aren't buying boats like baby boomers did. They're choosing experiences over assets, rentals over ownership. They'd rather spend $200 to rent a boat 6 times a year than take on a $60,000 loan. The ownership society that built the marine industry is being replaced by the sharing economy. Richard Howson from the Marine Industry Association put it bluntly. This isn't just a correction, it's a fundamental restructuring of how Americans think about recreational boating. The industry built its entire infrastructure around a customer that no longer exists in the numbers they need. As we enter 2025, bankruptcy attorneys are circling the marine industry like sharks sensing blood. Private equity firms are preparing lowball bids for distressed assets, waiting for the moment desperation overcomes pride. Industry insiders whisper about who'll survive and who'll become cautionary tales in business schools. The consensus is grim but clear. Brunswick, with its diversified portfolio spanning from engines to parts to electronics, will likely weather this storm, bloodied but breathing. They have the cash reserves and the credit lines to survive 2 more years of losses. MasterCraft and Malibu face a darker path. Both are exploring strategic alternatives, corporate language for desperate merger talks or Chapter 11 bankruptcy. Their boards are meeting weekly now, not quarterly. Every decision is about buying another month of runway. Marine Products Corporation may not see 2026 as an independent company. They're already in preliminary talks with potential acquirers, though at prices that would have been insulting just 2 years ago. Yet in this wreckage, something interesting is emerging. Electric boat startups are raising venture capital at record rates. Arc Boats just closed a $70 million funding round. X-Shore, a Swedish electric boat maker, is expanding into the American market precisely because traditional manufacturers are weakened. Boat-sharing apps report 200% user growth. Companies like BoatSetter and Get My Boat are doing what Uber did to taxis, turning boat ownership from a necessity into an anachronism. The rental market is exploding even as sales collapse. Freedom Boat Club, owned by Brunswick, ironically enough, added 40,000 members last year. People want the boating experience without the boating commitment. They want the sunset cruise without the storage fees, the fishing trip without the maintenance nightmare. Perhaps this collapse isn't just an ending, but a forced evolution. The industry that refused to change for 50 years is being dragged into a future where ownership is optional, propulsion is electric, and the weekend warrior has been replaced by the hourly renter. The great boat market collapse of 2025 will be remembered not for the billions lost or the companies that fell, but for exposing a simple truth. Industries that build for yesterday's customer using tomorrow's prices are sailing toward a storm they'll never survive. The question now isn't whether the boat industry will recover. It's whether what emerges will be recognizable to those who built it.